Welcome back, traders and investors. We have Michael Khouw on the line. He's managing director and primary strategist at Dash Financial, former managing director and head of equity derivatives at CRT Capital Group. Mike, how you doing on this expiration week?
Very well, thanks.
Okay, I gave a little bit about your background at CRT Capital. Can you just give us a little bit else of your experience in the markets? I see you were a floor person. Do you miss the floor?
I think every person who started their career on the floor probably misses it to one degree or another. It was obviously a very different business back then, but I really loved it, and it was one of those situations where you really could take the temperature, I think, of the market because all of the participants were all around you. When I first started, a lot of the products that I traded were singly listed. That meant that if you traded those products, they traded in your pit. So you got to see the sentiment of pretty much every market participant. And besides that, there was a lot of camaraderie, even amongst people who competed with one another in the marketplace. And so I rather miss that. That's not to say that technology and everything else that's been applied to the markets hasn't improved significantly. It has for sure. It's a better marketplace for investors than it has ever been. But I do miss the floor.
When did you make the move upstairs?
So I started on the floor in the 1990s, and I finally went upstairs a little after. Actually, we just had the anniversary of it, but a little bit after September 11th, actually. So I was a floor trader trading basically cash-settled indices on the Philadelphia Stock Exchange first. And I just to refresh the memory of those who are listening, the ETFs are a relatively recent development, and I started before ETFs. And in the early days, when people wanted to trade a sector, they commonly did so by trading an index product. So obviously the OEX and the SPX on the Chicago Board Options Exchange are commonly known, but maybe a little bit less commonly known were the sector indices that traded on the Philadelphia Stock Exchange, things like the Oil Service Index and the Bank Index. So that's how I started. And then we also had a specialist unit that traded a lot of oil service names as well as that index. So I went to the American Stock Exchange for that, and still with some focus on energy, I subsequently moved over to the New York Mercantile Exchange, where we had a book that traded options on natural gas, options on crude, and we also traded some of the products, so gasoline and heat. And after September 11th, I decided, to see what other opportunities might exist, including some outside of New York City. And a good friend of mine and an investor I greatly respect was a portfolio manager at a hedge fund based in Los Angeles called Ivory Capital.
Uh-huh.
Ivory is a pretty good-sized hedge fund, runs a long-short book, $4 or $5 billion, and they invited me to go work over there as an analyst. And I was about ready for a change at that time, so it was around late 2002, I think, early 2003, if memory serves. But that's already more than a decade ago, so the exact date escapes me.
So you have an extensive background in derivatives. Been trading them. Are you still active in derivatives, or are you more just leaning in the actual equities markets and futures?
We're very active in derivatives. Actually, Dash Financial is one of the larger brokers for listed options in the United States. I think we do probably about 5% of the total options volume on any given day, probably 10% of what's traded electronically, something like that. So my colleague Mark Guffner and I actually have just putting the finishing touches on a book about derivatives, as a matter of fact. But we provide advice to a lot of institutions with respect to trading derivative products, primarily U.S. listed options. So that would include all of the products I was just mentioning. But yeah, we're very active there.
Okay, so you've been active in derivatives for a while, and a lot of people, blame the last financial crisis on, the derivatives and the exotic products that we had related to the housing market. Do you see any indications in the derivatives market that we're coming to some sort of speculative bubble like we did back in 2008, or people keeping a pretty good risk reward ratios, and derivatives are not going to drag us down?
Derivatives are such a broad
Term.
asset class. When all we say is derivatives, I think it certainly has become a little bit of a dirty word based on everybody's experience with the credit crisis. But it is quite broad. It was not the equity or equity index or commodity derivatives that really had anything to do with what happened in the credit crisis. And there's a really big difference between that, I think, and over-the-counter credit derivatives. So I think it's important that we make that distinction. It's interesting as we look at the listed space. We're not seeing that much concern in the market. I would say maybe a little bit less than I would expect. The credit derivative space, however, remains substantial. When you take a look at the notional value of credit derivatives outstanding right now, we're talking about many, many hundreds of trillions of dollars, trillions with a T. So it's an immense market. But the other thing that I think is important to remember is that what also gets lost in those statistics is that a lot of those contracts and those derivatives contracts offset one another. So I think probably with a lot of the financial regulation, and I'm not necessarily an advocate for much of what's happened, but I think that we're probably better capitalized now. We definitely are better capitalized in the United States. I think our banks are the strongest in the world right now, so I'm less concerned. But that's not to say I'm unconcerned.
Okay, so at Dash, you guys are making markets and listed derivatives pretty much, and on our show we talk a lot about the weekly options, and there's a lot of activity that goes on there. And one indicator that a lot of our options traders like to look at is the open interest, is to see where a stock may get pinned going into expiration. Is that part of your strategies as far as making the market listed? If you guys start getting see a player coming in and too much and one option coming in expiration, does that kind of give you some signals of some future price activity?
It certainly can be an indication. I will tell you that for the most part, our own market views tend to be somewhat longer term. We spend a little bit less time worrying about what's going to happen within the next day or two. But I think this is an important consideration for all of your listeners. And that is that there is a tendency for an underlying asset, so that could be a stock or a commodity or whatever, to gravitate towards close strikes where there is a substantial and unusual open interest. And that's market data that every market participant has access to. That's something that you can take a look at. With respect to looking at the weeklies from one week to the next, one of the observations I would just very quickly make is that there's very one-sided flow in weekly options, by and large. And I'm going to give a little statistic that I thought was kind of interesting. A good friend of mine used to run the EVT group, that's the Electronic Volatility Trading Group, for one of the larger banks. He ran that group for a long time. He was an experienced derivatives trader, worked for what later became a subsidiary of Goldman Sachs, making markets. And he told me that in 2012, something close to 65% of the entire group's profits came only from trading weekly options in Apple. And I find that to be just an extraordinary statistic. I mean, an entire bank that's making markets in hundreds of individual equity and index options generated 65% of their profits from just one tenor, that is to say one expiration of one stock. And the important thing that I think everybody needs to hear is that they were always sellers. They were sellers of those options. What's going on here is that since the introduction of weekly options, it has been a really attractive vehicle, especially I think for retail investors, to make short-term directional bets on underlying stocks. And Apple, of course, was the one that generated the most retail interest. And what they were doing was making 7-day bets or shorter on what Apple was going to do. Now, what's attractive about that, of course, is that there's a lot of leverage. What is unattractive is that, in general, if you are a part of the herd that is all buying something, it tends to distort the price. And the reason that bank was able to make so much money trading those options was because retail market participants only buy short-dated options. You never hear about people doing an overwrite with a 5-day horizon. So from the volatility trader's perspective, it distorted the price of those short-dated options. That is to say, it drove it up fairly considerably. And they were able to just basically be short those and long other options in Apple against it as a hedge. So if anybody's going to take anything away from this, while it is exceptionally attractive to try to take advantage of the leverage that really cheap options look like they provide, just bear in mind that you're probably taking the other side of a market maker's bet when you do that. So unless you have a really specific catalyst and you have a really strong view about the outcome of that catalyst, you might want to stay away from those. Here's a recent example from Apple, the iPhone 6 release, right? So if you take a look at what Apple prices were implying, they were suggesting a pretty big move in a very short period of time on the announcement of the iPhone 6 and what also turned out to be the iWatch. Then take a look at what the price of the stock actually did. Moved up a couple percent, and then it drifted back essentially to where it was. The change that people expected in those short-dated options was far greater than what they actually got. And so, give yourself a little bit more time. That's the takeaway I would provide if you're going to be purchasing options to make directional bets in stock. It's a fine thing to do. Just make sure you give yourself enough time for your thesis to play out.
Wow, some excellent points there. I mean, we talk about the weekly options as like mini lottery tickets, and we all know who makes the money from the lottery, and that's not the people buying the tickets. I'll tell you how they made that 65%. I'll tell you, for a good part of last year, I was trying to play Apple from the long side, and I was trying to do it via the weekly options, and it was very, very frustrating. I just would have been so much better off just buying a 6 or a 9 or even a leap on it and forgetting about it, instead trying to time the market on a weekly basis. And then when Carl made his move in August, announcing his stake, I didn't have anything on and I never chased it. So that's an excellent point, and I think everyone listening should really pay close attention to that, because that's who does make the money in the options. It's the options writer, and I'm sure that they are not doing it naked either. They're doing it, with protection with the stock, or also, they might even get inherent protection in some of the options that they're selling to other people. So that's really a great point. What are your thoughts on Apple now? It's ripping into pre-market here, getting up. It looks like it's going to test its all-time high. Do you have any opinion on an individual equity like that?
Well, I have opinions. I guess I have opinions on a lot of things, but so that means I certainly have opinions on individual equities. I think it probably is going to trade above its all-time high. One of the things I think that a lot of people probably miss about Apple, and we have we have blinders on, I think, in the United States sometimes when we think about the scale and scope of the businesses that we invest in. And I think Apple's probably a fairly good example of this. So the naysayers for this type of a stock will say, okay, well, they basically have to keep delivering. So every time they come up with a new product, It's harder for investors to get excited about its potential. They just want to make sure that it isn't a relative disappointment compared to the products that they've had before, right? So if the concern about a new iPhone is not so much is this thing going to be a blockbuster, because their market share in the United States is already so great. There's a risk, I should say, that people think that it's going to underperform. But I think what gets lost in that is that we are actually a relatively small marketplace, and Apple has a relatively small, compared to the United States at least, share in China. The other thing is that I think Apple's, some of the things that actually make it more attractive relative to other electronic products companies is that they have other sources of revenue. I don't really know how their payment services group is really going to do, but let's just say that that's a call option for their business, right? So they have an incredible distribution platform. Everybody I know that owns an iPhone is likely to replace it with the iPhone 6. So I think that probably suggests that we're at least going to be able to maintain. But we have the largest market possible in the world that actually has relatively low levels of penetration. So you combine that with the fact that the stock is not trading at incredibly rich multiples. Combine that with the fact that the stock is, probably $150 billion worth of it or so is cash. And it seems unlikely to me that it wouldn't actually reach new highs here.
Okay, go also with derivatives. I mean, I know a lot of it's mathematically based with the theoreticals. What about the charts? Are you much of a technician at all? Do you pay attention to technical analysis? And if so, what do you like? What analysis techniques do you like to follow?
So I would never call myself a technician or a technical analyst, although I think it's safe to say that I do pay some attention to what technical analysts have to say, and I'm going to provide a little bit of a history here so that we can think about it. The reason I pay attention to it is because I'm interested in changes in momentum. So if you take a look at how we view the world, we have a couple things that we look at, but we are constantly screening, looking for stocks that look undervalued in our opinion. We also look for ones that are overvalued. I'll throw that out there, but we don't really recommend or consider shorting that often. And the reason is because, in my experience, you can have very good ideas on shorts, but if you get the timing wrong, it can be disastrous. It is a lot easier to remain committed to the long side than it is to the short side over time. And I've seen some people with some outstanding ideas on short stocks that timed it improperly and really had a hard time with it. The reason I'm interested in technicals is because if you're one of those investors that is looking for a good long opportunity, and let's just say, for the sake of argument, that you have a couple simple criteria. I'll use some examples. Let's just say that we're looking for stocks that have at least 4 to 5% growth over the course of the last 5 years. Okay. Let's also say that we are looking for stocks where we think that, based on historical multiples of a stock's performance, that there's at least 15% worth of upside. If we're looking at the Russell 3000 stocks today, there's probably, maybe 10% of the Russell 3000 would fit the criteria that I just provided. That is to say that they've had growth over the last year, 3 and 5 years, that growth rate exceeds our economic rate of growth in the U.S., that they're trading with still some decent potential upside. So these would be nice opportunities on the long side. Well, even though only 10% of the Russell 3000 might meet that criteria and actually look like attractive longs, that's still a much broader number of underlying securities than almost any investor would ever have in their portfolio. So the question is, once you've done some due diligence and you say, okay, 10% of the investable universe of U.S. stocks are attractive as longs to me, but I'm only going to have 30 to 50 stocks in my book, we need another set of criteria to establish what those are going to be. And this is where I think technical analysis can really help us, because
we have seen just lost Michael here at the tail end of that interview. Did the call drop on there?
Oh, looks like he's still in there. Not sure where he went.
Okay. Sorry about that, but we just lost the end of the interview here with Michael Khouw, managing director and primary strategist at Dash Financial.